Thank you very much, Maninder, CEOs, other senior officials from the banking and I see from the SEC, insurance. Thank you first to Maninder for inviting me to be here with you. What I'm proposing to do, though this is strictly a banking roundtable, is to kind of abuse the privilege of being able to stand here before you to talk a little bit about the efforts that have been made to stabilize the economy. I think some of you have probably heard this before, but let me quickly run through it and then talk a little bit about what the central bank has been doing in its regulatory function as far as the banking sector is concerned. On stabilization, I think probably up till early February, I would have said that there was encouraging progress being made towards achieving both internal and external stability within the economy. And even since then, the picture remains broadly the same, but clearly the political uncertainty has added a layer of risks in the economy which were not there a couple of months ago. If you look at both the internal and external indicators of stability in the economy, there are grounds to be cautiously optimistic. In terms of internal stability, inflation right now, in April, the headline inflation had come down to 3.8%. Of course, we had a little peak in inflation in the fourth quarter of last year, but that was largely supply-driven. Due to distortions, due to supply disruption caused largely by the drought and also the floods. And within that, food price inflation was the main driver of this peak in inflation. Food price inflation, in fact, went up to about 12 or 13% and took headline inflation up to 8%, outside the central bank's 4 to 6% target. But then the supply situation has now improved. The Maha harvest has come in. The government has imported rice. The government has imported coconut kernel. The two big drivers of food price inflation were rice and coconut. So having got through that supply disruption now, inflation is back down well within the target, 3.8% as I said. And we anticipate inflation remaining very much within the target of 4 to 6% through this year. Even if the government were to introduce the automatic fuel adjustment formula, we still think inflation will remain within the target. So that's in terms of internal stability. On the external side, the current account deficit slipped to 2.6% of GDP as against the target of 2.1% last year. And that again was largely due to the disruption arising from the drought. The oil price bill increased substantially as thermal generation had to be ramped up with hydro power being severely constrained due to the drought. And of course, there was a price effect of the rise in oil prices as well. And we had to import rice. I think now in a decent year, in terms of a decent harvest, we don't need to import rice. Last year we had to import quite a lot of rice. So it was basically rice imports and fuel imports. There was a third item, and that was gold. Gold imports went up to about $650 million last year. It was running at around 150 million. But then we took away the tariff. The idea behind taking away the tariff was to encourage the import of gold for the domestic industry. But what transpired was that there was a sharp increase in gold imports but that was not translated into manufacturing activity within the country. Instead, what seems to have happened is there has been a lot of leakage through to India. So the government has now reimposed the tariff, and now there is no possibility of arbitraging the tariff differential between Sri Lanka and India. So hopefully we've closed that leakage. And this year, the current account deficit is likely to be around 2.1% of GDP, which is a deficit which we can fund on a sustainable basis. So both the domestic and external key indicators of stability are pretty good. And I should also mention that reserves are at a record level at the moment. They went up to close to 10 billion. They've come with some debt repayments. They've come down to 9.7 billion now. And there's been a steady build-up since the end of 2016. At the end of 2016, gross reserves were 6 billion. They increased to 8 billion at the end of 2017. Not only was there this $2 billion US dollar build-up in gross reserves, but the quality of reserves improved as well, because we were able to mature swap arrangements, short-term swap arrangements with the commercial banks. The swaps stood at 2.5 billion at the end of 2016, and at the end of last year they had come down to 1.5 billion. So we were able to mature $1 billion worth of swaps as well. And reflecting that, the coverage, the gross reserve coverage of short-term obligations, which stood at 53% at the end of 2016, went up to 63% at the end of last year, and right now it has gone up above 70%. So the quality and quantity of reserves have improved. We intend to mature another 800 million US dollars worth of swaps this year, and also to pay down some of the expensive SLDBs. How are we going to do that? Of course, we have this 2.5 billion ISB issuance a few weeks ago. On top of that, the government is in the process of raising a syndicated loan of US dollars 1 billion, and there's been a pretty good response. And within the next 4 weeks or so, they should be able to close a deal on that. So that's another billion. And then there's 700 million of the Hambantota port money, which should come in, I think, at the end of March, end of May or early June. And hopefully, if the fuel price adjustment formula goes through cabinet, we should get about 220 million US dollars from the IMF as well. So in addition, there could be the sale of the Hyatt, Hilton, and one or two other bits of commercial real estate, which could bring in further money into the non-debt creating side of reserves. As far as non-debt creating reserves were concerned, I should also point out that last year the central bank, on a net basis, was able to purchase 1.6 billion US dollars. I should perhaps say something about that, because as you know, the exchange rate has been under pressure for the last week or 10 days. We don't really see any reason why that should be so. If you look at the fundamentals, the reserves are at a record level. The real effective exchange rate index is now at about 100. So there aren't any fundamental reasons why there should be this pressure. Of course, external developments, number of currencies, emerging market currencies, the Indonesian rupiah, the ringgit, the Indian rupee have all been under some pressure. So that's part of the story. But we still feel there has been more volatility than was warranted. So having not intervened on the selling side of the FX market since about March of 2017, in the last week or so, we have sold some dollars into the market to stabilize the rate, and we will continue to do so because we now have the reserves to defend the rate, to avoid volatility. I mean, there's a commitment to having a market-oriented exchange rate, and that will continue, but certainly the central bank would not allow sharp volatility in the exchange rate and would intervene to smooth the path of the movement of the exchange rate. So that's what's happening now. So all in all, on the macro side, the economy, as far as stabilization is concerned, is in reasonable shape. Now, whenever we go around, the question we are constantly asked is, what about the IMF's EFF facility? Will the government, with the upcoming kind of electoral calendar, will it stick to the program? And also, what about after the program? When the program ends in the middle of next year, will there be the discipline that's necessary to ensure that we have the macroeconomic fundamentals? Because as you know, we have a very mixed track record when it comes to our macroeconomic fundamentals, and much of the instability comes from the government's budgetary operations. So in order to try to sustain the improvement that has been made, there is at the moment a process of institutionalizing some of the changes. So if I can take each of the macro instruments one by one. On the fiscal side, as you know, and that's at the heart of the fund, extended fund facility and the government stabilization program, there is revenue enhancement-based fiscal consolidation that has been underway. And so far, broadly speaking, that has been on track. There was some slippage in the overall deficit, but that was almost entirely due to flood and drought relief, and the IMF accommodated that. By and large, up to now, it's been on track. And in order to institutionalize the improvement in the fiscal performance, before I go on, I should mention a couple of factors. I can highlight a couple of factors. One is that for only the second time since 1955, there was a surplus, a primary surplus in the budget. There was a very small surplus, I think, in 92 or 93. So this is the second time. And for the first time since 1987, there is likely to be a surplus in the current account of the budget. So some of the structural weaknesses that have persisted for many, many years in the government's fiscal operations seem to be being addressed. So that, and I think so far the VAT has been a major contributory factor, the VAT reforms. And when the Inland Revenue Act kicks in during the course of this year, and there'll be a full year of implementation next year, we should see further improvement. And this revenue enhancement-based fiscal consolidation, hopefully, will gather momentum. Now, how do we make sure that this persists? The government is negotiating with the IMF to introduce some fiscal rules. The Fiscal Management Responsibility Act, which was introduced in 2002, I think it is, 2002 or 3, does have some targets for the overall deficit and debt as a percent of GDP, but it lacks any teeth at all. So in just about every year since the time it was introduced, the targets have been breached. So what the government is moving towards is to have a framework whereby that framework can only be breached for very specific reasons, such as relief after a natural disaster, or an exogenous shock beyond the control of the government, causing a severe recession and necessitating strong counter-cyclical fiscal policy to counter that severe recession. So there would be specific reasons as to when you can breach the targets, and even then, when the target is breached, the government has to announce how it intends to come back on track. So those fiscal rules will be introduced in the period ahead. Secondly, on monetary policy, as you probably all know, the central bank is in the process of putting in place a flexible inflation targeting framework. And there, as I said, the target is 4 to 6%. The central bank has strengthened its forecasting and analytical capacity, the modeling and forecasting capabilities. And also the Monetary Law Act is being amended to strengthen the legal and accountability frameworks, which would support the flexible inflation targeting framework and which will also lead to a more independent central bank. And on the exchange rate, as I said, the idea is to have a flexible exchange rate policy with intervention only to smoothen volatility in the market. In addition, the central bank is working on some intervention rules. That will make it much more transparent. Now we've kind of intervened as we saw the situation being more volatile than was warranted in terms of the macro fundamentals. But we are working towards having a set of intervention rules which would then make clear to everybody as to when and how the central bank would intervene in the FX market. So we're working towards that as well. So the whole idea is to institutionalize these frameworks which are being put in place to ensure that we have a robust and data-driven macroeconomic policy making. So that's the story on the macro side. On the growth side, as you know, growth came out at 3.1% last year, which was very disappointing. It actually surprised to the downside because I think it's the first time in my living memory we were significantly, the official number was significantly lower than the IMF number. The IMF was actually estimating 3.7% growth. We came out at 3.1. We were estimating 3.8%. People were clustered around the 4% growth number, but it actually came out at 3.1%. And clearly that's unsatisfactory. So there is now a tendency for people to think that one needs to kind of open the floodgates, that you need to loosen policy, fiscal policy, loosen monetary policy to pump up growth, which is completely the wrong thing to do, because you really have to drive growth through reforms. Where there has been a problem is that while the stabilization program has taken place, of course the whole purpose of tightening fiscal policy, of having prudent monetary policy, is to curb excess demand in the system. That naturally will have a dampening effect on the growth process in the economy. You have to counter that by having reforms, which will boost growth. What you mustn't do is go for a kind of a short-term sugar high by pumping excess demand into the system. And that is what we have to somehow resist, because that is the great temptation when growth comes out below expectations. So we need to maintain the discipline and accelerate the reforms. What has really happened is that while stabilization has moved forward fairly well, the reforms have not moved as fast as they should have done. So what the government is doing, and it is doing a fair amount in terms of improving the investment climate, improving investment promotion, improving trade facilitation, and then all the trade policy things, including the trade agreements, all that needs to move faster. And that's really how we need to drive the growth process. So let me, with that, get down to what I really should talk about, which is the banking sector. And there, I think the overall message is that the banking sector is in pretty good shape. The Basel III standards are, except for two very small banks, we don't foresee anybody having major problems in terms of meeting the regulatory capital requirements, and the various liquidity ratios are also in fairly sound shape. So the sector is in pretty good shape. Credit growth has moderated to, I think it's now just below 15%, which is roughly where we want it to be. So that's also encouraging. There's been a slight increase in the NPL ratio, which I guess is inevitable when growth slows down, but it's still at 3%, hasn't hit the amber light territory. Next, let me speak a little bit about what the central bank has already done in terms of regulatory reform, and then tell you a little bit about what is in the pipeline. So what has already happened, as you know, the minimum capital requirements have been enhanced. I don't need to give details to this audience as to what the different categories are and what the capital, Tier 1 capital ratio is for each of those categories. In addition, the liquidity coverage ratio has been implemented and falling in line with IFRS 9, banks are moving from an incurred loss model to an expected loss model. That process is also underway, and I think the central bank is moving towards providing a 3-year window for that transition to take place. And the foreign borrowing limits there's been regulations, there have been directions issued on the foreign borrowing limits, and we've also issued a direction related to derivative transactions. So these are some of the measures that have been taken already in terms of regulatory action by the central bank, and there are a number of other planned regulatory reforms to strengthen the resilience of the banking sector. One is there are amendments taking place to the Banking Act to modernize it and to strengthen the overall regulatory framework, and also to strengthen the hand of the regulator in terms of taking action to deal with violations. At the moment, the powers of the central bank are very circumscribed in terms of dealing with violations, and the power of the central bank to deal with such violations will be strengthened through amendments to the Banking Act. The net stable funding ratio, the NSFR, under Basel III requires banks to maintain a stable funding profile in relation to its composition of assets and off-balance sheet activities. The consultation paper has been issued, and directions related to the NSFR will be issued in the second half of this year. A fourth reform relates to the issuance of preliminary guidelines related to the adoption of the Sri Lanka Financial Reporting Standards 9. And again, work is being done in consultation with the Institute of Chartered Accountants to issue preliminary guidelines, which will be done shortly. A fifth measure is the introduction, or a proposed measure is the introduction of a new share ownership policy for licensed banks in order to strengthen corporate governance, to avoid ownership concentration and dominance in the bank's boards, to address conflicts of interest and risks in relation to related party transactions. Share ownership of banks need to be broad-based, and therefore the existing requirements related to share ownerships will be reviewed, and a policy encouraging shareholders of international repute and diverse skills in the banking sector to hold shares in the banks will be encouraged. So that's another area where the central bank will be taking action. Yet another proposed measure is to strengthen the fit and proper assessment criteria for directors and KMPs. So that, again, work is being done, and there will be consultations, and to ensure that persons of integrity with proven track record of good conduct will be considered for appointments in the banking sector. There are also amendments that will be issued to the guidelines for the selection of external auditors to licensed banks. Yet another measure is the implementation of the regulatory framework for the appointment of agents. And banks will also be encouraged to implement recovery plans so that they minimize the adverse impact of troubled banks and the spillover effects that will flow through into the financial sector as a whole. A consultation paper will be issued to banks in this regard shortly. Yet another measure is the roadmap on technology risk resilience. And here, the roadmap to improve technology risk resilience in the banking sector will be implemented after consultation. And of course, the idea is to have market-driven consolidation. The capital requirements will be used to encourage banks. At the moment, we have, I think, 26, if I'm not mistaken, licensed banks and 7 specialized licensed banks. So really, if one's honest, we have far too much bricks and mortar, particularly in the context of rapidly evolving fintech. We really need to see how we can consolidate the sector, give it the clout to be able to absorb new technology without too much disruption. How to do all this without creating instability is a challenge for the regulator. We certainly want to encourage technological development, but we need to do it in a context where we really have too much bricks and mortar. So how do we move to where we want to get to is going to be a challenge, which all of us need to work together to resolve. Finally, I think in my notes I was told I should say something about the impact of Basel III. Clearly, as I said, banks are on track to meet the standards, and that will create a more robust banking sector. And the liquidity ratios will enable us to be able to withstand shocks in a more robust way. But at the same time, I think one has to concede that there is likely to be a squeeze on credit. This is something the developing countries argued very vehemently at the BIS when the Basel III framework was being developed, that the standards were pitched too high as far as developing countries were concerned, and that it could have an impact on credit flow. And clearly it will, so we need to keep an eye on that. So our objective in the central bank is to continue to enhance the system based on internationally benchmarked regulations and best practices. And clearly, as a regulator, we depend a great deal on all of you in the banking sector to help us to make sure that the sector remains robust and secure. Financial intermediation is the lifeblood of any economy, and we need to work together to ensure that it works in a stable way. Thank you all very much.